investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. I'm starting off with the VIX and the S&P because for the past couple of weeks I have not been reporting on the S&P. I just felt that talking about the VIX being inversely related was more than enough to figure out what was going to happen with the S&P. But as you can see from the chart of the VIX here, I did leave my lines on from last week's report, and you can see that the VIX followed my forecast exactly. I said that the VIX would most likely drop earlier in the week and then rally towards the end of the week, with the end of that line right there being my target. And today's high, as I record this on April 26th, today's high matches perfectly with that target number. So what does that mean for next week? Well, if you look down at the bottom here, you'll see the CCI, which is the Commodity Channel Index for the VIX, is showing downward pressure, downward momentum. And therefore, this could mean that the VIX will drop next week. I believe that if we extend this support line right there, I think that would be a safe bet that the VIX will drop and test this support level. You can see that in the past, the VIX has done just that. It's come down to that support level and then bounced a couple of times, and therefore I think we will see that happen once again. So let's hop right to the S&P and the spiders, ticker symbol SPY. I don't have any lines on there because I didn't make any forecasts, as I mentioned, for the past couple of weeks. But if you look back here at the highs right there in September of 2018, that high is still holding as resistance. Now remember what I said, I'm bearish on the VIX short term, but I expect to see a bounce. That means we're bullish on the S&P short term and would expect a pullback. So I think we're going to actually go up. Let me condense this price line here. I think the S&P is going to go up early in the week and then possibly pull back and hold that resistance. So I'm going to leave that just like that and see whether or not that forecast pans out as we expect it will. Now, another thing you have to pay very close attention to on these spiders is that there is a support level right here, which is a gap fill support level. If you're following along with gap strategies, you'll know 80% of the time gaps fill. And then once they fill, there's another 80% of the time where they reverse. Now again, there's no guarantee that that gap will fill. However, when you're looking at an individual stock versus an index, there's a higher probability that the gap will fill on an index because there's a basket of stocks involved. In the S&P 500, there's 500 stocks. The Russell 2000 is 2,000. The Dow obviously is 30. So chances are the market will pull back. When that will happen, I couldn't tell you, but this resistance is our near-term target area right here, and then we'll have to see whether or not the market storms up to new record highs. So there's a lot going on. We had some mixed results this week with regard to the diamonds. If I pull that up, that's ticker symbol DIA. I said that we would pull back from resistance, and guess what? We went past that resistance point. It was almost a breakout. We didn't see this happen on strong volume, so technically it's not a breakout. But we did pull back towards the end of the week as I forecasted. We just didn't hit the target. So what I think is going to happen, again, you can see there's gaps below the market here on the diamonds. I'm going to erase all these lines and redraw what I think we'll see for next week. This gap fill point right there is going to be a short-term target, but it will also act as resistance. Remember, 80% of the time after a gap fills, it reverses. So I think we're going to go up to fill that gap, and then I think we're going to pull right back to this 20-period moving average. I'm not expecting to see explosive volatility of any sort, but I do think that these gaps are going to fill, and then we have to watch to see whether or not the gaps on the downside will fill as well. So that's the diamonds. If we look at a more broad-based index in the Russell 2000, Russell 2000 also pulled back and held resistance up here. It just didn't pull all the way back to my target. Now again, I think the Russell 2000 is going to follow what we're talking about here in the diamonds, where I think we're going to see a rally up to resistance again, and then I think we will pull back to retrace and possibly gravitate back to that 20-period moving average. I like the 20-period moving average. There's 5 trading days in a given week and 4 weeks in a month, so that gives us 20 trading days in most months, and therefore that moving average tracks that. Keep an eye on the CCI. You could see that we have some upward momentum going here, but as soon as that CCI starts to pull back, I think you'll start to see the price action follow that. CCI is a little bit more sensitive to changes in that momentum, so that's why I'm pointing that out too. If you don't have that on your chart, I would recommend you keep the CCI on your chart, possibly stochastics, and of course you want to look at the volume as well. Now let's look at the Qs. QQQ is the tech sector. We did not pull back at all. In fact, we rallied over that resistance and we set a new high. In order to find out where the next resistance is, it'd be a good idea to back up. But guess what? We don't have any other resistance to guide us to a point where we think we can see a pullback. So we're basically in new territory here with the NASDAQ at record highs. I'm going to remove this and then zoom in on the weekly chart because I want to count the number of green candles with you. 1, 2, 3, 4, 5, 6, 7 green candles in a row. That's called a stale green light. With the exception of this red candle, we had a tremendous rally in the NASDAQ since the beginning of the year. I think we are long overdue for a pullback here. The volume is still increasing on the weekly charts, but we're going to have to keep an eye to see whether or not we get a drop in volume next week on the daily chart. So I'm just going to move this line over. Again, I think we're long overdue for that pullback in the NASDAQ. I think we're going to do that pretty early on. I don't know if we're going to go much higher, but we can definitely see prices pull back to that 20-period moving average, mainly because it's been a long stretch since the price action has even touched that blue line, which again is the simple moving average for 20 days. The momentum indicators down here, stochastics is crossing with a sell signal, and the CCI is only 9 points away from that generating a sell signal. So keep an eye on that. If you'd like to learn more about what we do at The Market Guys, just go to The Market Guys website. It's pretty easy, www.themarketguys.com. Click on the video tab right there, and it will bring you to a library of videos that we call Market Shots. I would like to draw your attention down about halfway down the page here to the video that says the 1% rule. When the markets are pressing the highs, sometimes we start to feel invincible. I would encourage you not to feel that way, but instead be more protective of any profits that you have at this point and to defend against what could be a major pullback. So we don't want to be caught by surprise. We want to have good risk management technique in place with the strategy that's easy to follow, and that's exactly what the 1% rule does for you. So that's it for now. Have a great weekend, and we'll talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.